We're jumping straight into Teradyne today. Everyone is watching the price action, but the real story is the massive shift to AI infrastructure dominance.
Exactly. You tune into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the gears and circuits of this thing, do us a huge favor. Subscribe to the show and hit that like button. We spend hours combing through all the noise, the earnings calls, the technical models, so you don't have to.
Yeah, we do the homework.
If you want the signal without the static, you're in the right place.
And right now, the signal on Teradyne is, it's practically deafening. We're looking at a chart that has gone completely vertical.
Just a straight line up.
But the question we have to answer today isn't just about the stock price. It's about the engine under the hood. Is this just hype, drafting off the tech rally? Or is the fundamental business actually changing gears? Because when you see 11 different analysts upgrade their price targets all at the same time, it usually implies that the market suddenly realized it was looking at the company through the wrong lens.
It's so rare to see that kind of uniform capitulation from the analysts. Usually you get a few holdouts, but let's set the stage. For anyone who hasn't looked at their portfolio in the last, 48 hours, Teradyne is crushing it.
Absolutely crushing it.
We are talking about an all-time high sitting right around $317.
Which is a staggering move, especially for a company that's been around as long as they have.
And the catalyst wasn't even an earnings call, which is the weird part. It was the UBS Global Technology and AI Conference.
Right.
Whatever they put on those slides, the market just devoured it. The stock surged 23% in a single day.
A single day. That's a massive move for a large cap company like this.
It really is.
But we need to look past the percentage gain and at the narrative shift. You said it at the top. Shift to AI infrastructure. That's the key phrase. For so long, Wall Street viewed Teradyne as, a cyclical proxy for the semiconductor industry.
Right, the old story. Samsung sells more phones, Teradyne sells more testers, PC sales go down, Teradyne goes down.
It was a roller coaster tied to consumer electronics.
But the data coming out now suggests that the old Teradyne is basically being relegated to the back seat. They are morphing into something else entirely. An AI pure play in disguise.
The numbers back that up.
Yeah.
This one of the stat that forces you to just rewrite your whole model. AI now makes up over 60% of their total revenues.
60%.
And in some of their really high-performance segments, it's pushing over 70.
That's complete identity shift. That's not a side hustle anymore. That's the main event.
Precisely. And that 60% figure is the pivot point. It means the company is no longer tethered to the slow, inventory-heavy cycles of consumer gadgets. They're tethered to the AI build-out.
Which is an arms race.
It's an arms race. And unlike the phone market, which is saturated, the spending here isn't optional for the big tech giants. It's existential.
So let's unpack the bull case, because the revenue rocket, as you like to call it, seems to be firing on all cylinders. But I want to dig into the guidance, because this was the shocker that really caught everyone off guard.
Go up, Foley.
Management came out and projected, 65% revenue growth for 2026.
And just to put that in context, because 65% sounds nice in a vacuum, the consensus on Wall Street, the average of what all the smart money expected was only 39%.
Wait, so they didn't just beat the estimate, they crushed it by 26 percentage points.
They blew it out of the water.
Yeah.
Usually management tries to guide conservatively so they can beat and raise later. Here, they're coming out swinging.
They're being aggressive.
Very. They are guiding for growth that is drastically higher than what the market was priced for. That tells you the order book is filling up faster than even the most bullish analysts realized.
And it's not just promises for next year either. Look at the fourth quarter of 2025. They just reported revenue growth of nearly 45% sequentially.
Right. And sequential is the key word there. That's quarter over quarter.
In 3 months.
Growing your revenue by nearly half in just 3 months is blistering speed for a hardware company. Software companies can do that. They just sell more licenses. Teradyne has to build and ship these massive, complex machines.
It's a logistical feat. But here's where I want to get into the weeds a bit. Revenue is vanity, profit is sanity. It's one thing to sell a lot of machines, it's another to make money on them. What's happening with the margins?
That's the earnings multiplier effect.
Right.
When your revenue goes up that fast, you get what we call operating leverage.
Okay.
Your fixed costs, your R&D centers, your headquarters, admin staff, those costs stay relatively flat. But the revenue explodes. So every extra dollar of sales drops almost straight to the bottom line.
And that's what we're seeing here. The adjusted earnings per share, The EPS, it beat expectations by over 3,000 basis points in Q4. That's wild.
It is. It creates a situation where profit grows significantly faster than revenue. We are looking at an EPS run rate potential of approximately $8 per share.
$8 per share?
Correct, and that figure it crushes the estimates for both 2026 and 2027. So when you ask why the stock is up 23% in a day, that's why. The market is suddenly realizing Teradyne is going to generate a lot more free cash flow than anyone thought.
Okay, so the money is flowing. But let's play devil's advocate. When a company starts printing money like this, it attracts sharks. What stops a competitor from swooping in and saying, hey, we can build a tester for cheaper? Why is the moat so wide?
That is the critical question. To understand the moat, you have to understand what they're actually testing. This isn't 2015 anymore. We aren't testing a simple logic chip in a plastic package.
Right.
We're in the era of advanced packaging.
Okay, stop there. Advanced packaging. Break that down. Are we talking about the box it comes in?
No. We are talking about the architecture of the chip itself. Think about an NVIDIA GPU or a modern AI accelerator. It isn't one single piece of silicon anymore.
It's more complex.
It's a chiplet architecture.
Yeah.
You have the logic core, then you have stacks of high-bandwidth memory HBM, and they're all sitting on a silicon interposer. It's like a layer cake, a lasagna of silicon.
A very expensive lasagna.
Exactly. And the industry term for this is CoWoS chip on wafer on substrate. And here's the problem. You have to connect all these different pieces with thousands of microscopic connections. If just one of those connections fails, the whole unit is trash.
And these units cost what, $30,000, $40,000 a piece?
Easily. So the cost of failure is astronomical. If you're a manufacturer, you cannot risk using a second-tier tester. You need a machine that can test that specific, fragile, complex architecture with zero margin for error.
So you can't just swap out your testing equipment mid-cycle to save a few bucks.
It's way too risky. It's like trying to change the engine of a plane while you're flying it.
Yeah.
You stick with what works.
That's the switching cost moat.
Precisely. And on top of that, Teradyne just has a technological lead. We're not just testing if the chip turns on. We're testing high-speed data connections, optical interconnects. These systems have to move data at terabits per second. Teradyne has proprietary capabilities here that competitors like Advantest are, frankly, struggling to match.
And that leads perfectly into their strategy, which I love, the 1 + 1 = 3 strategy. It sounds like bad math, but...
It usually means synergy. And here, it refers to their partnership ecosystem. The buzz right now is all about the joint venture with a company called Multilane.
Right, Multilane. I keep seeing that name pop up. Why does that specific partnership matter so much?
So, historically, you test the chip itself. That's the engine. But an AI data center isn't just a pile of chips.
Sure.
It's servers, it's networking gear, and crucially, it's the optical cables connecting everything at light speed. The joint venture with Multilane allows Teradyne to test the entire AI data center stack.
So they aren't just checking the engine, they're checking the transmission, the wheels, and the road it drives on.
That is a great analogy. It represents a massive expansion of their total addressable market.
Yeah.
They are moving from just semi-test to system test.
And the CEO, Greg Smith, he was very explicit about this. He said he expects these partnerships to show material benefits starting in 2026. This isn't some R&D project for the next decade. This is a now plan.
And the big money is noticing. You mentioned the upgrades. The analyst at Stifel raised their target to $325. But what caught my eye was the reasoning. They didn't just say AI is growing. They explicitly cited share gains against competitors.
So they think they're actually taking market share.
They think Teradyne is taking share from Advantest. And that's a key distinction. This is a broad repricing by the sell side. This isn't just retail traders on a message board getting excited.
Okay, so that's the bull case. And honestly, it sounds amazing. 65% growth, expanding margins, a massive moat. But
there's always a but.
We run the easy money show, not the everything only goes up show. We have to look at the other side of the coin.
We do. And we have to be realistic here. The stock is up 183% in the past year. That is vertical.
It's parabolic.
And in financial markets, when things go straight up, they often come down to test support. It's just gravity. We have to play the voice of caution here.
So let's talk valuation vertigo. What are the risks when you're buying at an all-time high of 317?
Well, the biggest risk is simply that the stock is priced for perfection.
Right.
When you tell the market you're going to grow 65%, you have to grow 65%. If you grow 64%, the stock could crash. The expectation bar is set incredibly high.
And there's a technical model we looked at that's predicting a potential pullback.
That's right. There is a correlation pattern model that suggests the stock price has detached too far from its moving averages. It predicts we could see a pullback of around, I think, 17% in the next month.
7–10%.
Now, that doesn't mean the company's broken. It just means the stock got too hot too fast.
But 17% is a significant haircut if you just bought today.
It is. Even the analysts at Northland, who raised their price target, explicitly flagged valuation concerns. They're basically saying, we like the company, but wow, this is expensive.
And then there is the concentration risk. We celebrated that 60% AI revenue stat earlier. Isn't that a double-edged sword?
It absolutely is. It creates what we call binary risk. Teradyne is now tethered entirely to the AI build-out cycle. And think about who is buying all this stuff.
Yeah.
It's the big three or big four hyperscalers.
NVIDIA, Meta, Google, Microsoft.
Exactly. So if Mark Zuckerberg wakes up tomorrow and says, you know what, I think we have enough servers for now, Teradyne takes a direct hit.
Their revenue doesn't just dip, it could fall off a cliff.
Precisely. They don't have that diversified safety net of the broad industrial market anymore because they've leaned so heavily into this one vertical.
So if you're holding this stock, you are basically betting that the AI arms race does not stop.
Correct. You are betting on the sustained spending of 3 or 4 companies. That is a very concentrated bet, and that can be a scary thought.
It is. And then there's just the basic market dynamics. We're at all-time highs. Institutional investors have made a lot of money on this name.
And they have mandates to rebalance. If a stock doubles in a pension fund's portfolio, sometimes they are required to sell some just to manage their risk rules. So we could see a period of consolidation simply because the big funds are locking in profits.
Which is healthy, but it feels painful if you just bought at the top.
Sure.
So we have a revenue rocket with a massive moat, but it's flying at a dizzying altitude with some binary risks attached. If I'm a listener trying to figure out what to do next, what should I be watching? Let's break down the triggers for 2026.
Okay, 3 or 4 key things to keep on your radar. First and foremost, earnings.
Q1 2026, that's coming up in late April.
Yes, and because of where the price is now, a simple beat might not be enough. You need to watch for a beat and raise scenario.
They need to beat Q1 and then raise the guidance for the rest of the year.
To justify this current stock price, yes. If they just meet expectations, the stock could easily sell off.
Okay, so late April is the report card. What about before then?
Watch the partnership milestones. We talked about that multi-lane joint venture. Press releases matter here. Are they announcing their first commercial wins? Are they actually getting that gear into a data center?
We need to see proof that 1 + 1 = 3 isn't just a marketing slogan.
Exactly. If we see news confirming that the JV is generating real revenue, that validates the whole thesis.
And the third trigger.
Zoom out to the macro signals. Watch the broader AI CapEx news. You don't even have to watch Teradyne specifically. Watch what the cloud providers are saying.
Right.
If Google announces they're increasing their infrastructure budget, that is a tailwind for Teradyne. If they announce cuts, that's a huge warning sign.
It's a symbiotic relationship. If they spend, Teradyne wins.
And finally, watch the price levels. We mentioned that potential 17% dip. We need to see if that $300 to $320 zone holds as support.
So if it dips to 300, does it bounce or does it break through?
Right. And keep in mind, there is an expected semiconductor cycle inflection in the second quarter.
Yep.
The whole industry is expected to move from uncertainty to sustained demand. If that happens, it puts a floor under the stock.
So Q2 is really the proving ground.
That's the timeline.
So let's wrap this up. We've covered a lot of ground. To summarize, Teradyne has successfully transformed. They aren't just a cyclical hardware vendor anymore. They're a secular AI infrastructure play.
That is the headline. They have high growth, expanding margins, dominant market position. But you have to pay a steep price for admission right now.
It's a premium ticket for sure.
It is.
So here's a thought I want to leave everyone with. We talk a lot about cycles in this industry. Hardware booms, hardware busts. But with AI becoming woven into every part of the economy, are we looking at this wrong? Is Teradyne still a hardware company subject to booms and busts? Or are we witnessing the birth of a long-term utility for the AI age?
That is the billion-dollar question. If they're a utility, the valuation might just make sense. If they're just in a cycle, it's a bubble.
Something to chew on while you watch that ticker tape? That's the lowdown on Teradyne. Keep your eyes on the data, not just the hype.
And don't forget to subscribe so you don't miss the next breakdown.
We'll see you next time.